Welcome back. Before we begin, I must tell you how thrilled I am to be able to provide this information to you. While I've been in the life insurance industry for the past 25 years, truly I've been in, I think, my entire life, all 44 years. Why? Well, I've been mentored by what I consider to be the greatest, and many who consider him to be the greatest marketer and communicator of life insurance concepts in the country, and that's my father, Barry Kay. I learned a very valuable lesson from him years ago. He said, "Listen with application." And I ask you, the viewing audience, to take these concepts and see how they apply to what you are trying to accomplish in your estate planning goals. Some of you may like the idea of the Social Security optimization. Others may be looking for a way to maximize the ultimate value of your IRA, and some may simply just be looking for a way to discount estate tax cost. Whatever it is, remember, at the end of the day, we're talking about life insurance, and we're going to help you achieve your estate planning goals. Let's begin. The most basic concept, discounting your estate tax costs up to 90%. This was created many years ago, and I must tell you that all the concepts that you will hear today have been implemented by my family as a result of our family creating these different approaches. So, how do you discount an estate tax cost up to 90%? Well, let's assume you have a $10 million estate. We know that the estate taxes are approximately $5 million. Now, depending upon what happens with the estate tax laws, will determine whether that number is higher or lower. In any event, using this as an example, very simply, I want your family to structure an irrevocable life insurance trust. This trust would purchase a $5 million life insurance policy. That's the amount of the actual estate taxes. Now, what would the cost of this policy be? Well, let's assume I have a couple, husband and wife, age 70, and let's assume they're in excellent health. The one-time cost of that policy would be approximately $1,250,000. Well, think of it this way. If you paid $1,250,000 into the trust, and the trust ultimately pays out to the beneficiaries, your children, $5 million, completely income and estate tax free, well, then I guess you could say you received a 75% discount on the estate tax cost. Why? Because your family paid $1,250,000 as opposed to the $5 million that would have come out of your $10 million estate. The choice is yours. $5 million net to your family or $8,750,000. Assuming you and your spouse are age 60, that same one payment for the $5 million of insurance owned by your irrevocable life insurance trust would be approximately $600,000. So in the same vein, I guess you could say you received an approximate 88% discount on your estate tax costs. Why? Well, again, your $10 million net worth has an estate tax due of $5 million approximately. The irrevocable trust owns $5 million of insurance, but what did you pay for that $5 million? You paid $600,000 one time to guarantee that policy for the rest of your lives. Again, an 88% discount on your estate tax cost. Now, you also have the option to pay annual premiums. You may not want to come up with a one-time payment. So therefore, going back to our couple of age 70, that $5 million of insurance is going to cost approximately $75,000 annually. So once again, discounting your estate tax cost, the most basic of all the estate planning concepts.